Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang, and we are zooming in on the Singapore economy, which might see flat growth this year, with the official forecast now downgraded to a range of 0 to 2% from 1 to 3% previously. And this as we saw the economy in the first quarter this year grow 3.8%, slower than the 5% growth recorded in the previous quarter. That's according to the advanced estimates from the Ministry of Trade and Industry this morning. And this was below as well private sector economists' median forecasts of 4.5%. So what does this mean for the rest of the year? How much of a slowdown should we expect? Should we still brace for a recession? To help us out, we've got Selena Ling. She is the chief economist for OCBC Bank. Good morning, Selena. How are you doing this Monday morning?
Good morning, Ryan. I'm good.
All right, lots to unpack here when it comes to numbers. And I believe the latest data is slightly better than your forecast.
Yes, that's right. Actually, I was looking for about 3.5% year-on-year growth, about a 1.1% quarter-on-quarter seasonally adjusted contraction. So coming in at 3.8%, actually, this is slightly better than what I was expecting, although it's a little bit below what the street was calling for.
Yeah, help us unpack what's going on here, because we were bracing for slower growth, so much going on in the backdrop when it comes to tariffs, trade wars, and so on. Walk us through the various sectors.
Sure. So basically, manufacturing estimate at 5% is a little bit better than what we expected. I think this could be due to a little bit of a front-loading effect ahead of, the Trump tariffs that were announced on 2nd of April. That said, we do expect that manufacturing momentum will slow in the coming months, as this tit-for-tat between US and China gets underway. Nevertheless, we did see the full-year growth forecast also being downgraded to 0 to 2% as what I was expecting. I think going ahead, I think the key thing is that if the domestic labor market starts to cool a little bit more significantly, then we should see some dampening effects on the services side. I mean, as it is, the financial services, infocoms have seen a little bit of a slowdown in terms of the growth momentum. And in particular, I think retail sales is already feeling some of the heat from, the external uncertainties. So it's not a surprise that, once we hit the second half of this year, where the base effects from last year are much higher, we could see the growth numbers come off a little bit more sharply.
Yeah, so this goes to the point of how we should be or expecting slower growth in the coming quarters because of all the uncertainties. And to that point, that downgrade to window 0 to 2% for full-year growth. What are your forecasts for the rest of the year? What sort of slowdown are you pricing in?
Well, if you look at 2024, first half growth was around the 3+% handle, and then it went up to 5+% handle in the second half. So it's very likely that this time around, given the higher base in second half next year, the 3+% handle that we are seeing, in the first quarter this year probably may actually fall much further. So that's the reason why they actually cut the forecast to 0 to 2%. That's it. Actually, a lot of the tariff announcements, as we have seen in the past weeks, a lot of flip-flops, a lot of exemptions, and then a pause, and then, layering on new tariffs as well. Especially the sectoral tariffs that people are watching for will be the pharma and semiconductor side. So it's still something that's a game in play. It's hard to say exactly what would be the hit to the Singapore economy, but I think it's just a precautionary move to anticipate that there will be some slowing in the global growth prospects, and especially on the trade front.
Yeah, so lots to watch out for in terms of how this could manifest for Singapore. All right, the other part of the conversation is what's going on with the monetary policy. Singapore has eased its monetary policy for the second straight time, and this, worth noting, after the January meeting where it loosened policy for the first time in 5 years. Walk us through what's the thinking here. What is the driver behind this decision? What would have happened, or the risk if settings were left unchanged?
The consecutive easing again was what we were expecting, mainly because core inflation had come off quite sharply in the first 2 months of this year. And given, all the headwinds, the tariff announcements that will probably be deflationary in nature because it will dampen, Chinese growth and also regional economies, given that the tariffs on our ASEAN neighbours are actually quite punitive as well. So the outlook from here is twofold. One is that the output gap is going to turn negative this year. And secondly, we do expect that with the cooling that we see in the external prices, especially in the energy complex, also coupled with, imported inflation coming off, domestic labor market also cooling. So I think in general, we are seeing less risk on the inflation front. So actually, if anything, there's more downside risk to inflation from here. So the rhetoric is actually very dovish. We do think that we cannot rule out a further monetary policy easing if economic conditions continue to deteriorate from here.
Yeah, so that's interesting to watch in terms of how this will play out for inflation, especially with the tariffs and the global trade war. Is there a chance of China or Chinese goods finding an alternative market and finding their way to Singapore and then just helping to ease some of these pressures with cheaper prices?
I think that's something that market watchers are trying to anticipate. Given that US-China have levied 145% tariffs on each other, it is very likely that Chinese goods will have to find alternative markets. So, there's some concern about whether these excess Chinese supply coming to ASEAN markets will actually give a big downward push to imported prices. I mean, you can see it as a double-edged sword. I mean, consumers may welcome cheaper prices, especially for key products. If you look at what Chinese are good at, it could be your consumer electronics, it could be electric vehicles, and a whole slew of other manufacturing goods as well. I think the concern, on the other hand, really would possibly be from some of the local industries where they are competing in the same space as some of these Chinese products. Then, they would come under some competitive pressure as well. So I think it's going to be a little bit of a double-edged sword. Good for consumers, maybe not so good for local manufacturers, especially if they are in the same space as the Chinese good coming in.
All right, Selena, just to recap, we've got growth forecasts now officially 0 to 2%. That's a downgrade from 1 to 3%. What is your forecast for this year, and are we likely to see a recession?
Well, I think at this moment it's really quite hard to tell because although we've had a 90-day reprieve for the reciprocal tariffs for the rest of the world, US and China are still going at each other. So we have to see whether there are any off-ramps to negotiation that could bring down tariffs. I think the other story really for Singapore is that, like I mentioned, because of the high base in the second half of last year, we will expect a slowdown in momentum. So in that sense, a technical recession may not be completely out of the picture, although a full year-on-year growth may still escape contraction on a 2025 basis. I think we have to watch what happens with the manufacturing and the trade prospects, but also I think domestically, whether there's going to be further support coming from the fiscal side is also something to be watchful for, given that monetary policy already has been eased twice.
All right, we will watch to see how this all plays out, especially for the services sector, like you pointed out, is going to be a key driver for growth in Singapore. We've been in conversation with Selena Ling. She is the Chief Economist for OCBC Bank, helping us to break down the latest forecast for Singapore's growth this year, downgraded to 0 to 2%. Selena, thanks for your time this morning.
Thank you.
All right, catch up again soon. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.